Hi everyone, welcome to my channel. Today we're going to talk about related party transactions and how to account for them in ASPE and IFRS. If you like what you see, please give this video a thumbs up and also consider to subscribe. So here's an overview of what we're going to be talking about today. The first is going to be going through key related party transaction terms. So these are the definitions that you need to know to be able to go through related party transactions. The second is going to be knowing what is the related party transaction criteria and then how to apply them in a case. And then lastly, we're going to go through a case scenario where you're able to solve a related party transaction using the carrying or the exchange amount. So now let's talk about related party transaction definitions. These are key terms that you need to know before you can ever solve a related party transaction. So now let's talk about who are my related parties. As a company, there's various definitions of who they can be. The first are any party who can exercise direct or indirect control, joint control, or significant influence over the entity. It could be an immediate family member of a related party. So for a company, this could be, let's say, a parent corporation or a joint corporation that is also managing the company. In terms of individuals, this could be the owner's family members or a key shareholder's relative or someone that is very close to them that can basically tell the company what to do. Now let's talk about the key definitions. There's going to be the exchange amount and carrying amount. The exchange amount is essentially the sale price, and then the carrying amount is what the book value is of that item when the transaction happens. The next definition we need to know is commercial substance. Commercial substance is when there is a change in cash flow. For example, when you want to give away a car and you want to get back, let's say, books, or you want to get back some service, there's different cash flows of those items. In addition, there could also be change in entity specific value. What the entity believes that value of what they're giving up is also different from what they're getting back. There's also substantial change in ownership, which means unrelated parties obtain or give up to 20% of the ownership of the company that is doing the transaction. The next key definition is the normal course of operation. What this means is that these are things that the business does frequently, are good at, and is just something that they do every single day or close to every single day, and it's just very normal for them to do it. Next, let's talk about related parties and what their criteria are and how to actually use them in cases. So now let's talk about related party transactions decision tree. This is in ASPE. So first we start with this is a related party transaction. Then we ask ourselves, is this transaction in the normal course of operations? What this means is this what the company does for their bread and butter? Do they do this often? Do they do it frequently? Do they do this almost on a daily basis? If the answer is no, then you ask yourself, is there a substantial change in ownership? And we talked about what substantial change of ownership is, which means it's a 20% change in ownership. If, again, the answer is no, then you're going to measure this whole transaction at the carrying amount. Any differences in the value that you're receiving versus what you're giving up, you're going to make that difference and put it into equity. If, for some reason, there is a substantial change in ownership, then you ask yourself, can the exchange amount be independently verified? If your answer again is no, then you're going back to where you kind of started before, where you're going with the carrying amount. Okay? But if, let's say this transaction is either it is in the normal course of operations, or this exchange amount can be verified independently, then you ask yourself, is this a transaction of non-monetary exchange? If the answer is yes, then you ask yourself, is the item exchange sold normally within this business? Again, is it something that we sell normally to everyone? If your answer is yes, then you're going back to carrying amount. However, if your answer is no, then you ask yourself, is there commercial substance? What does this mean again? It means that there's going to be a change in cash flow in the items that we're exchanging. If your answer is yes, then we're going with the exchange amount, which means any differences between what you're giving up and what you're receiving, those gains and losses go to your net income. If there is no commercial substance, you're going back again to carrying value. And another way of getting to the exchange amount is if this is not a monetary transaction. Then you go directly and you go into exchange amount. Okay? Hopefully this tree diagram helps you understand how to get from the start to the finish under ASPE. I know it's a lot of steps, but if you want to know, in IFRS, it actually gets a lot more simpler because in IFRS, you just start with the exchange amount, and that's all you do. Because in IFRS, it's very plain and simple. They just tell you to use the exchange amount. There's not a lot of guidance around it, and it's really just using the exchange amount and then you moving on. So now let's talk about related party transactions in relations to IFRS a little bit more. In IAS 24, it talks about the disclosure requirement. In IFRS, it really goes really heavy on disclosure instead of how to actually account for it. So as we talked about in the previous slide, you're really just going with the exchange amount unless there's another standard that provides guidance on it. And then after that, the IFRS standards kind of really go in depth on what do you need to disclose. So you have to talk about, what is the nature of the relationship within related parties? What are the nature of transactions that are going on? What are the amounts of transaction? And who are the key management in terms of compensation and all that? So now let's go into something a little bit more exciting. Let's go into the case example. We're going to solve an example of how to use carrying and exchange amount in a case. So now let's look at an example. Windows Ltd, W, and Events Inc, E, are owned by the same owner. W is in the business of window cleaning, and E is in the business of event planning. W sold one of its vans to E. The van had a book value of $55,000 and was sold to E for its market value of $25,000. The loss on sale has been included in the gross margin of W. Both companies use ASPE. So the question here is this transaction correct, yes or no? We see that one company sold a van to another company and they're both related. So how do we know if this is correct or not? We have to go through the criterias again. So now let's look at the related party transaction decision tree in ASPE. We know it's a related party transaction because it's the same owner that owns both the companies. Now we have to ask, is this transaction a normal course of operations? No. It's a window washing company that's selling a van. They don't normally sell vans to everyone. The next question we ask, is this substantially change in ownership? Is there a substantial change? Most likely, no. It's the same owner, there's no shares being changed. Therefore, we're just measuring all this at the carrying amount, and the differences should be a change in equity, not to the change in margin like we read in the question. So now let's look at the solution I wrote for this example. The issue is W recorded $30,000 loss on the sale of a van to E. We need to see if this is actually appropriate. So the analysis is, as per ASPE, if items sold are not in the normal course of business and not significant ownership change in the item transferred, the items should be measured at carrying value. W and E are both owned by the one owner and therefore related parties. This transaction is not in the normal course of business for W because they don't sell vehicles. In addition, there are no change in ownership within this transaction. As a result, I would recommend that the transaction should be therefore recorded at the carrying amount, which is the amount of the items transferred as recorded in the accounts of W. The loss of $30,000 should be removed from the income statement and recorded in equity. So now let's look at the journal entry that they should have had. Windows Limited should have debited cash for $25,000 and then credited the van for $55,000 because they no longer have the van. And then they should have debited equity for $30,000 instead of debiting their loss for $30,000. From the buyer's perspective, they should debit the van for $55,000, which is the book value of what W had, and then they would credit equity by $30,000 and then the cash of $25,000 because that's what they paid. So now let's look at our second example. Building Limited and Events Limited are owned by the same owner. Building is in the business of selling buildings, and E is in the business of event planning. B sold a building to E. The building normally sold for $500,000, but E was only charged $200,000. The owner are not sure how to account for this transaction, both companies are using ASPE. So to summarize, it's basically one company sold a building to another company. So how are you going to account for this? If we go back to our related parties transaction decision tree, we're going to first notice that, of course, it's a related party transaction because they're all owned by the same owner. We're going to ask, is this transaction a normal course of operations? Yes, because Buildings Limited is in the business of selling buildings, and they did sell a building to Events. So then we ask ourselves, is this transaction non-monetary exchange? No, because they're getting paid, right? There's actually cash value to this transaction. So therefore, we must measure this at the exchange amount, and gains and losses will go into net income. So now let's look at the solution for our example 2. The issue here is B is not sure how to record the building sold to E. As per ASPE, if items sold are not in the normal course of business and no significant ownership changes in the item transferred, the item should be measured at the carrying value. Otherwise, it is recorded at the exchange amount. Both B and E are owned by one owner, therefore they're related parties. This transaction is a normal part of B's operation because B sells buildings for a living, and is monetary because it's getting paid $200,000. As a result, this transaction should be recorded at the exchange amount, which is the sale price. B would record the loss of $200,000 on its income statement. Here's an example of how the journal entries should look. Building should record a debit of a cash, $200,000, which is what they received, and then a loss of $300,000, and they would credit the building that they sold, which is $500,000. And then Events would debit the building for $200,000, credit the cash for $200,000. Thanks again for watching. If you like what you saw, please give this video a thumbs up and also consider to subscribe. If you have any questions, please let me know in the comments below. If you like what you saw, please also check out one of my other videos on the CPA process.